Infrastructure Development Network, or FIDN conference. As many of you may be aware, the Financial Infrastructure Development Network, or FIDN, was established in 2015 as a key initiative under the 2015 APEC Finance Minister Cebu Action Plan to serve as the multi-sectoral platform among the APEC countries and leading international organizations intended to transform financial systems in the Asia-Pacific and to promote initiatives to make financial services in the region more accessible, especially to micro, small, and medium enterprises, or MSMEs. It aims to expand the reach of credit and other financial services for a more inclusive regional economy. Hence, its focus is on areas on credit information systems and secure transaction systems, together with insolvency frameworks that would facilitate the use of movable assets as collaterals in the credit markets. In this regard, later today, we will have sessions focusing on the SME financing landscape, fintech, supply chain finance, and e-commerce, as well as the state of credit infrastructure reforms in the Philippines and ways forward on this. Now, before I proceed to introduce our first speaker of the day, please allow me to mention some of our key house rules for this conference. First, to ensure the highest quality of experience, kindly keep your microphones muted at all times. Second, questions should be submitted via the chat button, and the selection will be filtered by the moderator during the open forum. Third, this session is being recorded and will be made available online in the FINEX Philippines page of both Facebook and YouTube. Fourth, for any technical issues, kindly message the FINEX technical team via chat on this Zoom platform. And fifth, kindly rename your Zoom name to your full name with your indicated organization for proper identification. At this point, please allow me to introduce our first speaker for today. Our first speaker was previously the Chief Financial Officer, Vice President Finance, and Treasurer, as well as the former Chief Risk Officer of Pilipinas Shell Petroleum Corporation, a cum laude graduate in BS Industrial Engineering from the University of the Philippines in Diliman in 1986. He also completed the Shell Group Business Leadership Program at INSEAD Singapore in 2005 and holds accreditations as a Certified Management Accountant and a Professional Industrial Engineer. He had held numerous finance and non-finance roles in the downstream and upstream businesses during his 34-year career in Shell, including international assignments in joint ventures in the Netherlands, Kazakhstan, Russia, and Brunei. A recipient of the ING FINEX CFO of the Year Award in 2014, he served also as the 2020 President of the Financial Executives Institute of the Philippines, or FINEX, and is currently the chairman of the FINEX Research and Development Foundation, the president of the Judicial Reform Initiative, and the treasurer of the Integrity Initiative. Ladies and gentlemen, it is my honor and privilege to now give the floor to Mr. Jose Jerome Jeng R. Pascual III, who will give the welcome remarks and the recap of the day one sessions of this conference. Jeng, you have the floor.
Thank you very much, Domeng. The Honorable DOF Secretary Carlos G. Dominguez, the Honorable DOF Assistant Secretary Maria Teresa Habitan, the Honorable SEC Commissioner Attorney Javi Francisco, the Honorable LRA Administrator Renato Bermejo, the Honorable LRA Deputy Administrator Attorney Ronald Ortil, the Honorable DTI Director Jerry Clavesillas, Attorney Francis Edlim, FINEX President, our distinguished speakers and panelists, honored guests from government, business organizations, and the rest of the private sector attending from here and abroad, FINEX colleagues, ladies and gentlemen, good morning. It is my great pleasure and a distinct privilege to welcome all of you to day two of the 9th Financial Infrastructure Development Network, or FIDN, conference brought to you by the Department of Finance, the APEC Business Advisory Council, and FINEX in collaboration with the Bangko Sentral ng Pilipinas, the Department of Trade and Industry, the Land Registration Authority, and the Securities and Exchange Commission. The theme of our conference is deepening reforms to reinvigorate movable asset, risk-based, and supply chain financing for MSMEs in a post-COVID era. It has been over a year since the COVID-19 outbreak began, and it appears like we are back to where we started in terms of the gravity of the lockdowns. We have been battling a global pandemic that has impacted our lives and businesses in ways we never imagined. And most severely affected are the micro, small, and medium scale enterprises, or MSMEs, that earlier, according to the World Trade Organization, made up over 99% of Philippine businesses, employed over 62% of the labor force, and contributed over 35% of GDP. All these statistics might be a bit less now. The passage of the FIST and CREATE laws, with a guide bill hopefully not too far behind, puts together some essential elements of the financial and fiscal support structure needed by businesses to make it to the post-COVID era. But more needs to be done. And there were two critical issues emerging from yesterday's sessions. Firstly, access to credit remains to be the key challenge for MSMEs. And second, more enabling regulatory frameworks and system platforms need to be put in place in order to move the needle. DOF Undersecretary Hilbert kicked off our conference by highlighting the need for a well-developed financial infrastructure to address the access to credit issue and look towards FIDN as a means of promoting the needed reforms. In response, APFF Chair Hiroshi Nakaso affirmed FIDN's capacity building role and recent achievements across the APEC economies, but also acknowledged the still inadequate credit flows to MSMEs. To him, the pandemic was a wake-up call to push the much-needed credit reforms. Mr. Nakaso sees the Philippines as a test case for effectiveness of financial infrastructure development, particularly in relation to the establishment of a modern collateral registry and the passage of the Warehouse Receipts Bill. In session one, we were introduced to the concept of secure transactions, the MSME cash cycle, and the great potential of movable assets in closing the collateral requirements gap between lenders and borrowers. To make secure transactions happen, a number of reforms are needed, particularly regulatory reform that leverages on global best practices, and registry reform, where digitalization becomes an enabler for robust online and centralized movable asset registers. We heard how such secured transactions and collateral registry reforms catapulted Brunei Darussalam's access to credit ranking from 129th place to first place out of 190 economies in just 6 years. In session two, we were enlightened on the power and benefits of a robust and reliable credit information system, including how ongoing commercial and government initiatives on digitizing credit information and credit risk can dovetail and complement each other in improving access to finance for MSMEs. Our panelists also highlighted the regulatory challenges that need to be harmonized, specifically in the areas of data privacy, bank secrecy, and anti-money laundering. And we heard how Thailand, through adaptive government policy and robust digital infrastructure, is moving forward from traditional collateral-based lending to leading-edge information-based lending. Today on day two, we will put more focus on the enablers that will ensure we move forward towards a sustainable path for credit infrastructure reforms. Session one will tackle the SME financing landscape, fintech supply chain finance, and e-commerce. This will be followed by the virtual ceremonial launch of the LRA Collateral Registry. Session two will highlight the current state and way forward on the Philippine credit infrastructure reforms, including the much-awaited Warehouse Receipts Bill, which we in Phoenix hope will be given priority and passed into law expeditiously. I am sure you are looking forward, as I am, to a rich and engaging discussion on these topics. it is important for us to recognize the good reforms already undertaken to enhance access to credit and the need to continue building trust and confidence in our financial infrastructure. I would like to take this opportunity to once again thank the Department of Finance and APEC Business Advisory Council for spearheading the FIDN initiative in collaboration with the Bangko Sentral ng Pilipinas, the Department of Trade and Industry, the Land Registration Authority, and the Securities and Exchange Commission. You can count on our continuing support as Phoenix. I also wish to thank our Day 1 and Day 2 speakers and panelists for being with us to share their insights and perspectives, and my colleagues in Phoenix, especially our President, Francis Lim, the Financial Inclusion Committee led by Ms. Gay Santos with Joey Camus, Domingo Go, and the Phoenix Secretariat. Good morning to you all, and have a productive and insightful Day 2 of our 9th FIDN conference. Thank you very much, and let me hand you over back to Mr. Domingo.
Thank you, Jeng, for your remarks and for providing us with a comprehensive summary of Day 1 sessions. At this point, ladies and gentlemen, I would like to call on all our attendees to kindly turn their videos on for our brief virtual photo session. The Secretariat will do this promptly and quickly, and you would not want to miss being included in the photo. So please turn on your videos promptly. Thank you.
Okay, good morning, everyone. Please turn on your videos.
Alex, I cannot turn on my video.
The video is being blocked. Host is blocking video.
Sir, check it now, sir.
All right.
Now it's the same. No, it still cannot. It still says, now, okay. Thank you.
Okay.
Okay.
You turn on your videos and smile. I will count to 3. Okay, ready? 1, 2, 3. Okay, that's for the first window. I will just save the file. Okay, for the second window, okay, just make sure that your cameras are open. Okay, ready? 1, 2, 3. Okay, just saving the picture again. Okay, third page, make sure that your cameras are open. Okay, ready? 1, 2, 3. Okay, just saving. Okay, last one, last window. Okay, ready? 1, 2, 3. Okay. Thank you. I already took the pictures of everyone. Back to you, Sir Doming.
Now, that was quick, wasn't it? Ladies and gentlemen, let me now, before I proceed, I'd like to acknowledge also the presence of LRA Deputy Administrator Bob Leretana, who I understand is also with us this morning.
Good morning. Good morning. Glad to be here.
Let me now, at this point, proceed to introduce the moderator for Day 1 of today's part of the conference, Mr. Tomas Mitch Gomez IV. Mr. Gomez, or Mitch, has worked in various senior management positions in the fields of insurance and financial services, and among others, was previously a governing board member of the Agricultural Guarantee Fund Pool, a trustee of the Rural Bankers Research and Development Foundation, Inc., president of the Rural Bankers Association of the Philippines, as well as a non-executive director of the Kedan Corp and managing director of the One Financial Group, Inc. He obtained his BS Business Economics cum laude from California's Notre Dame de Namur University in 1986 and his MBA from the University of the Philippines in Diliman in 1994. He likewise attended executive courses at the Harvard Business School, the Frankfurt School of Finance and Management, and the University of Asia and the Pacific in the Philippines. A fellow of the Institute of Corporate Directors, he is currently the non-executive director of GM Cycle Inc. and the General de Jesus College, as well as the president and CEO of GM Bank of Luzon Inc. It is therefore my privilege, ladies and gentlemen, to introduce Mr. Tomas Mitch Gomez IV, who will serve as the moderator for today's session 1, which will tackle SME financing landscape, fintech, supply chain finance, and e-commerce. Mitch, you have the floor.
Thank you, Doming. Ladies and gentlemen, good morning. Today's first session is about convergence, the convergence of technology, the law, and practice that can make or break transformative supply or value chain finance. As we listen to our panel of subject matter experts, let us keep in mind a key end goal: to provide better access and opportunity to MSMEs in their critical role of economic development. If water is essential for life, what is the needed ecosystem to give life to supply chain finance? Our first speaker will walk us through these life-giving elements. He is currently the Principal Operations Officer and lead for financial infrastructure, Asia and the Pacific for the International Finance Corporation, the World Bank Group. He has more than 34 years experience in financial services, private sector investment, and policy reforms in both Asia and Africa. He has served as head of the IFC office in Chengdu, the Deputy General Manager of IFC Advisory Services for China and Mongolia, and the Senior Country Economist and Chief Investment Officer of the African Development Bank. He has also served as board member in various regional banks, including the largest microfinance institution in China. He is an active supporter of the APEC agenda on financial infrastructure reform, trade and supply chain finance, and fintech market development. A leader in the Asia Pacific FIDN, please welcome Mr. Jin Chang Lai.
Thank you, Mitch, and hello to everyone. Good morning. So to allow for a better connection, let me turn off the video and start to share the screen. Thank you. So yesterday, several speakers has talked about the work of APEC FIDN and about the promotion of movable asset finance. I've been promoting this for some years in the region. Supply chain finance, or SCF, is a main segment of the larger movables finance market. Today, I will discuss briefly what is necessary to put a substantive SCF market in place. And I will talk more from a regional perspective, not necessarily specific to the context of the Philippines. So first, I will say that SCF is an approach to business finance. There are three elements that are important to distinguish SCF from the one-to-one lending relationship. First, SCF is based on receivables and inventory. And second, it leverages chain relationships. It means value chain relationships. And third, supply chain finance normally involves a big buyer or a big seller. And the other thing to understand is that supply chain finance is not only about credit, but it in other types of services, including risk mitigation, non-credit services such as ledger management, collection, and payment and settlement services. It can also include information and processing support. And the other thing to know is that in the market of supply chain finance, not only banks are around, but there are also a range of other players, such as non-deposit taking lenders and collateral management companies, supply chain management services companies, and more importantly, electronic platforms for receivables finance or warehouse finance. And for the third-party e-platforms, there are also numerous funders behind such platforms. And in addition to those, there are other types of services providers, such as business associations or business alliances, and government promoters and regulators. In the good markets, governments tend to support the digitalization of supply chains and the modernization of logistics services. In the case of Philippines, the MTI is actually doing some of this work from what I can see. So then the question is, what would be considered a good ecosystem for SCF? It means 3 levels of infrastructure, services, and competencies. So I will use these to explain a little. At the bottom of the first level, and there are legal and institutional arrangements that will allow SCF players to do their business, including any government support and promotion measures. At the second level, then there are provisions from the regulators about how the business can be conducted, and there are also industry associations which make the standards and provide common support services. So the second level is about the friendliness of the regulatory environment, whether or not there are sufficient competitions, and whether or not there are services that cannot be provided by one company alone, cannot be provided by the SCF players alone. And at the third level, these are specific SCF players, whether or not they have good competency and governance, whether or not they are willing to do SCF. So now for the first level, and there are these elements listed, and there are certainly more than what I listed here. And given the time limitation, I'm not going to go through each element. And I would only highlight a few things. For example, when you go to an economy, the first thing that we can ask is whether or not there are laws that will allow receivables and inventory be used conveniently and safely as collateral. As a supply chain finance is about receivables and inventory. In some economies, particularly those with civil law traditions, so their law actually says that you can do a transfer of the claims. Effectively means that you can purchase receivables, for example, but in practice, the lenders do not really use these instruments because they probably do not understand, or the government authorities never thought about it. So we have found such a situation in several economies. They still use the instrument of pledge, and at the same time, they say that they are doing factoring. But we know that when you say factoring, it means a purchase of receivables. So, but they are not using it. So this is one example. So another dimension is whether or not there are other supporting infrastructure, such as bankruptcy law. So are the secure creditors have priority over the other creditors? If you purchase receivables, how the purchase receivables will be under the bankruptcy law. So a good practice is that if the suppliers already sold the receivables, those receivables should not be included in the bankruptcy estate of the suppliers. Then in an economy, the question can also be asked whether or not the central government and the ministries or even local governments has appropriate promotion and support initiatives or not. So I will use an example here. This is a real example. Is in one economy, at that time, this was a few years ago, there are 13 million trucking business. These are fleet. So there is a company which is called QF Technology that have managed to connect over 5 million trucking business with APP and with internet connections. So such a thing cannot be done without the support of the government. And this trucking business, normally they are small business and they do have a cash gap that will need financing, which can be done in the context of SCF. And then there is a parallel company, which is called QF Finance, that will leverage this e-platform, is like a logistics management e-platform, to offer financing and other services to the members. Members means the trucking business that join this platform. Commercial banks and other lenders can lend through such a platform to support the smaller trucking business. So let me now turn to the level 2 of 2. So again, these are the key questions that I had listed here, and I will only highlight a few things. So people may think that banks are most important. Yes, it is true, but banks tend to be overly conservative. And for a good market, you will need numerous NDTL, which can be more innovative than banks. And you will also need some business associations or business alliance that can organize the players together. And again, the number of players in the SCF market is a lot. It's not only banks, not only lenders, as I said before. And hopefully they will also be other third-party services providers, such as collateral management companies, SCM services companies, and hopefully third-party electronic platforms. So again, I will use two examples. So the first example is a third-party e-platform based in Singapore. So any financials can actually finance the suppliers or sometimes maybe distributors through such a third-party e-platform. And in the good markets, Sometimes when you look at the medium and small banks, they have significant volume of SCF, but they may not have their own internal e-platform. This is because they try to leverage third parties to do their business. Another example is in another, and there is an association which does warehousing and collateral management. They are actually our client. So they have managed to develop a common pallet system. So pallets are for the warehousing and transport of goods. So instead of each company have your own pallet, they have a common pallet for the whole industry that can be circulated among the member companies. And there is a QR code attached to each pallet. So you only need to scan the pallet with your mobile phone, then you will know something about the goods. And this system had been put into operations a few years ago. So it has been very good to facilitate collateral management and for warehouse finance. So the third level is about the specific SCF players. So this essentially means whether or not the financials like banks or NDTLs, whether or not they understand the SCF market opportunities. Do they have appropriate strategy and resources to profit from such opportunities? Do they have competencies? So for example, do their risk managers understand the specific nature of the SCF business? For example, in the factoring business, typically the clients are higher risk clients, and the factors normally rely on transaction data and cash conversion to do their job. But often, risk managers who grow up in the traditional setting do not really understand. They will find trouble with the frontline people. And then whether or not the player is able to work with specific industries and to develop their SCF programs. Do they know how to make the lead funds? This could be anchors on board or not. So again, this is another example which used to be our client. So this bank has actually developed programs for potato farming industry. So there is a region in their area which is specialized in potato farming. So not only one leaf farm, but many leaf farms in that areas. So they have been able to make use of such a chain relationship to provide financial services, not only loans to the potato farmers, which normally small farmers. They have also been able to support the larger players, these are leaf funds, with their needs. So I'm not going to explain the details with the time limit, but more or less from the graph, you can understand what is really behind. So I will stop my brief talk here, and thank you, Mitch.
Thank you, Jin Chang. You educated us about the differences between supply chain finance and traditional one-to-one lending. You talked about the enabling levels, both real-world examples and key questions that must be met. And critically also that supply chain finance is not just about credit. It's also about risk mitigation, information and processing, and it's not just about banks. Fintech, platforms, and country case studies, causes, and advocacies close to his heart. Our next speaker has over 15 years of experience consulting for funders as well as corporates in trade and supply chain finance. Presently, he is the managing director of Convergence Capital Group in Hong Kong, which manages a fintech platform connecting funders and borrowers across 5 continents. Let me apologize. I read my wrong page of the script. Our next speaker, after this one, will talk about the case studies. But for now, factoring, supply chain, technology. Issues our next speaker are well versed. He has over 35 years experience in factoring. He acquired his expertise through on-site training assignments with banks and factoring companies in the US and the UK. He led the creation of DBS Factor. When DBS Factor was absorbed into DBS Bank, he became the head of regional factoring and provided critical factoring and financing to companies ranging from SMEs to large corporates. In 2012, he became the managing director of BB Financial Services, the Singapore subsidiary of BB UK, the world's largest independent factoring group. In 2015, he joined Factors Chain International to be its first Asia chapter director. He is an energetic advocate for international factoring and in training new factors in developing countries. Presently, he is the Asia Pacific representative of HPD Landscape, the world's leading asset-based lending, factoring, and supply chain finance platform provider. Please welcome Mr. Lee Keng Leong.
Thank you, Mitch, for the introduction. Thank you, Gay, for inviting me to this conference. And I'm happy to be involved in this conference since hello, can you see my okay?
Lee, we cannot see your slides.
Can you see my slide now?
Not yet.
Okay.
Yes, we can see your slide now.
Okay. My topic is on leapfrogging into the new technology. First, I will touch on the development of international factoring. International factoring has grown from euro 402 billion in 2013 to 504 billion in 2019. FCI international factoring volume grew from 357 billion to euro 458 billion in 2017, but declined to euro 298 billion in 2019. This shows that there is a growth in direct factoring and international factoring backed by credit insurance. Credit insurance also provides the protection if you are selling on open account. According to Bern Union, credit insurance has increased over the year, and in 2018, it formed 12.5% of the world trade, and that's quite substantial. In the international, the top 10 international countries, factoring countries are shown here. China, France, Germany, Italy, Spain, UK, Netherlands, Singapore, Poland, Korea, and the US. Asia Pacific volume form about 23% of the world volume of 2,197 billion. As you can see from this chart, there is no reported volume for the Philippines. And this is not because there is no factoring volume in Philippines, but because it's not reported, because there are no FCI members in Philippines, and therefore the volume is not reported. In the Asia Pacific region, China was top, and this was followed by Australia, and other countries are Japan, Hong Kong, Taiwan, and Singapore. COVID-19 has accelerated supply chain financing. There's an increasing interest in FCF with focus on working capital. And due to social distancing, COVID-19 has accelerated digitization adoption. You probably have heard about fraud in receivable financing. Recently, there are quite a few huge fraud cases in China, in Taiwan, and in Singapore. Therefore, there's a heavy investment in blockchain to prevent fraud. Banks are slow in adopting new technology. They are not nimble due to the legacy system. As a result, fintechs, which are more nimble, are eyeing for a greater share of the market. According to IFC, there is an APEC SME financing gap of US 2.4 trillion. Supply chain financing has been identified to help SME to meet this financing gap. However, according to McKinsey's study, there's a problem in the adoption of FCF. First is the fragmentation of delivery. Because many banks and non-bank financial institutions do not have a system, FCF delivery is manual and fragmented. And because of this, there is a fragmented data sharing. The onboarding process is slow and the credit decision is also slow. There's also fragmentation of the underlying asset. Due to the lack of technology, banks focus on highly rated, larger corporation and recurring high-value invoices. And in line with the common theme today, MSME struggle to get financing. There's also limited credit provision and FCF expertise. Provision of FCF is restricted by a number of banks and non-banks providers with sufficient knowledge and know-how. Many banks are unable to provide FCF due to lack of exposure or risk and limited expertise in underwriting. Again, as a result, most SME do not have access to supply chain financing. Are banks ready to go into supply chain? ICC has undertaken a study in 2020. According to the study, globally, 60% of banks do not have the FCF platform, and local banks in particular, 83% do not have FCF platform. There are many challenges identified in these studies. However, the four top challenges are lack of FCF platform, internal KYC problem, internal policy, and seller onboarding. There's also high investment costs in software, manpower, and hardware in developing FCF. What is the bank's preference? A bank preference is for an end-to-end delivery for supply chain financing. That is their ultimate goal. What does an end-to-end delivery look like? A single platform. One platform that provides recourse, non-recourse factoring, international maturity factoring, FCI international factoring, credit insurance backed factoring, supply chain financing, purchase order financing, and asset-based finance. This platform should have digital access, digital invoices submission, and client can access via multiple devices. It also should have quick and seamless onboarding. You can submission of invoice digitally, you perform audits, invoice, reconciliations, and onboarding digitally. The system should also come with risk analytic. It is embedded with risk analytics to prevent fraud, mitigate risk, and manage the client. So you can leapfrog into the new technology because they are state-of-art digital platform embedded with risk analytics, which are available on rental basis. You don't have to worry, just pay monthly rental. And there's no huge investment in IT infrastructure. You will be able to prevent fraud and other risks associated with receivable financing. Many people go into receivable financing without proper risk analytics, and as a result, they have fraud. And when they encounter fraud, then they start to perfect the risk analytic. You don't have to, because you can straight away go in the platform with the risk analytic available. Time to market is short because if you were to develop the system on your own, it may take a long time to go into the market. But with the availability of the system, you can go into market within a short period of time. And the system is a plug and play system. Just connect your PC and laptop, and you will be able to run your supply chain finance program, your warehouse financing program. So the lack of platform in the Philippines is a blessing in disguise. Why? Because unlike the existing player who has got a platform, you are not beset with legacy system, which are expensive to replace. You can leapfrog into the new technology and be the best in class. I repeat, without having to invest in high IT infrastructure. Here is an example of the state-of-the-art digital platform. A state-of-the-art digital platform will have the buyer portal, the funder portal, and the supplier portal. They link all the three parties together. And these three parties will all have access to information via client access, and it can be done via tablet or mobile. And the client can also request for funds digitally via this platform. The platform will also come with risk analytics. Here are examples of risk analytics. It's all available. Risk analytics will help you to overcome fraud. And one of the analytics is called the Benford Law. The Benford Law will collect information from the system. It only requires three information from the system: the invoices, the credit note, and the payment. With all these three information, you will be able to get a Benford Law curve. This Benford Law curve will show you that if it's deviation from this curve, there is a potential fraud, and you can look into it. So with this, I would like to end my presentation. Thank you for your attention.
Thank you, Lee. Lee spoke about first the international factoring trends, the key importance of technology versus fraud. Also talked about the huge gaps in SEF and especially the challenges and that banks don't have the platform. But he also talked about something interesting, which we can go back to later during the Q&A, that as far as the Philippines is concerned, it's a blessing in disguise, in the sense that we can leapfrog the technology challenge. For our speaker 3, this is take 2. Fintech platforms, country case studies, causes and advocacies close to his heart. Our next speaker has over 15 years of experience consulting for funders, as well as corporates in trade and supply chain finance. Presently, he is the managing director of Convergence Capital Group in Hong Kong, which manages a fintech platform connecting funders and borrowers across 5 continents. Previously, he has held leadership positions in two top global fintech companies specializing in supply chain finance. He has consulted for over 40 banks globally, as well as 100 corporates. In addition to his work with Convergence, Cliff has consulted for IFC on various operational projects and has been a guest speaker for the Asian Development Bank at various regional banking conferences. He is also a strategic advisor to boards of multiple fintech and insurtech platforms operating in various local markets in Southeast Asia. Please welcome Mr. Cliff Inchikin. Cliff, this is for you.
Hi, thank you, everyone. Mitch, thank you for that. And thank you, Gage and Chang, everyone, for inviting me today. Give me 1 second. Let me share my screen. Okay, so some of what KL just mentioned, I'm going to also reiterate. So talking about ultimately the supply chain finance technology landscape in general, really when we go in and consult banks, what are some of the obstacles that we see from a technology standpoint, and just some data to kind of back up the routes we think banks should be taking and regulators should be taking. And then specifically discussing two use cases in India, as well as some developments that are currently happening in Thailand, where regulators have gotten more involved in the technology aspect of supply chain finance and rolling these solutions out to the market. So it's pretty exciting what we see going on from a regulator standpoint. So initially, I just wanted to give an overview of the technology options that are available out there for banks or even non-bank lenders. So really, we break these up into two main components: internal or hosted solutions, where, let's say, the servers and the technology are housed within the four walls of a bank, or an external or software as a solution, or you might know as a cloud-based platform, where these are web-based offerings that are not housed within the infrastructure of a bank, but really managed and offered by an external service provider. So if we look at the internal hosted solutions and some examples there, so you're really looking at two main buckets coming out from the hosted solutions, whether or not they're internally developed or externally developed. So similar to what KL was just talking about, and one of the issues we always run into when discussing with banks is they feel they can take this on and develop it in-house. We're going to talk about some of the challenges for that, but obviously there are some banks that have done this and done this well. BNP Paribas is one that we've seen. They have their platform Connexus, which they developed in-house. And there's a few others. But eventually, one of the things is we see it's difficult for them to keep up to new trends in technology, but they often have very niche product knowledge behind them to drive these platforms. Externally developed means a platform that was built by an external provider, but can be housed within the four walls of the bank. So more or less the front end is attached to servers within the bank. It can be supported by the external provider, but you also have a level of support within the bank from an infrastructure standpoint. So some examples that we mentioned there below that. Really, a lot of what we see in the developing markets taking hold is the cloud-based models, because they are, I would say, much easier and quicker to get up and running and implement. Is there a question? Sorry.
Please continue, Cliff.
Yep, sorry. So really these can be broken up into multiple options, and these aren't a this or that option. These are, you could have multiple of these options in one solution. So one being a license where rather than just coming in and participating on a cloud-based or multi-bank or multi-funder solution, you're actually creating your own bank solution on this cloud-based platform. And often that comes with what's called a white label system, where, let's say if it's a Codex or an Abacus or Prime Revenue, it doesn't say that logo when your clients log in. It would actually have GM Bank and the colors as the logo on the solution itself. But it ties into the single database and infrastructure in the background, which allows for economies of scale. And then you really break it down to exclusive or multi-funder or multi-bank platform. So is this a cloud-based solution that was set up off-site, specifically supported for a single funding institution? Or is this the provider that is more or less managing this solution and database and is supporting multiple funders and multiple clients and intertwining relationships via this platform? So there are more intricacies and ways of looking at this, but these are some of the main buckets that we look at when we're talking to banks about what is the right solution for them, because each of these have their own different cost models, they have their time to market models. So all of that plays into the bank and the overall country strategy when looking at these. So another thing that we've run into, so like we said earlier, this internally developed versus externally developed, especially when we're consulting banks and we get all of the leadership together, and that leadership includes the CTO or Chief Technology Officer. More often than not, they are going to be pushing to build their own solution in-house. And from a cost perspective, this often does make sense, right? Because in some of these markets, you have a growing software development industry, and it's low cost to get some very high skilled people on board and build these solutions. Really, I think KL hit on this, really where we're seeing a lot of issues though, these banks, especially in markets where there's not an established supply chain finance industry, they don't have the product knowledge and the experience to know how these solutions should be developed. So yes, you can have the development skills and software skills, but if you don't have the ability to outline configurations and specifications of how a system needs to be built, then you're going to go through many trial and errors that become much more costly over the long term. So like I said, KL hit it on the head. The build strategy will take longer. It may seem less costs, but over time, those costs can compile and it can cause issues and time to market where it can really form cracks in the overall strategy and rollout structure of a bank. Whereas if you're buying a solution off the shelf, especially if you're going through a tried and true international vendor who's been in multiple markets, they've seen multiple legal issues, counterparty issues, they've been through all of these trial and errors already, and there are solutions that can be up and running in 30 to 60 days, especially if you're looking at cloud-based or software as a solution type platforms. So that's the big differences we see in this. And then we really try to push towards the buy strategy when we look at software solutions and when we're talking about banks and their rollout strategy of products, because otherwise their rollout is going to be pushed out from actual sales and the ability to scale these products. And again, you don't always need technology to get started on implementing a supply chain finance product. But if you want to scale and make that a major component of your business within the bank or the funder, then you need technology to do that scale. So that can obviously push, if you're putting all your efforts into software development, that can push your timelines out a year, 2 years, etc. So just to put it into context, we mapped out some of the banks operating in Asia Pacific, whether they work on the build strategy, so where they develop something in-house, whether they buy a solution off the shelf, or if they're still doing things manually. So this is based on where these banks lie on the assets under management line. So you'll see the largest banks internationally, HSBC, BNP Paribas, Bank of America, they have all built their own custom solutions. Even DBS has done a lot of in-house development on their solutions. You'll see we've got some very large banks in the middle tier buy that, like Rabobank, Mizuho, they went straight to the buy strategy. They wanted to implement solutions quickly, and that's the route they went. And then you've got some of the smaller banks, regional banks or domestic banks in Southeast Asia, South Asia, who are doing things, but on a manual basis. Now, that being said, there is a caveat to all of this. So while these very large banks are developing their own in-house solutions, they also collaborate on third-party platforms. So they're working with a Demica, they're working with a Prime Revenue. So they may have their own internal solutions, but they also participate on these third-party multi-bank platforms for larger programs as well. DBS is looking for implementing or buying their a solution as well. All of these banks we have listed here are looking to move to a buy model. So just, I did outline in context of assets under management, I did put BDO lands right here. So they would be within these group of banks you see in the Southeast Asian market, South Asian market. So two areas we've seen regulators get highly involved in the technology implementation in the markets. Specifically, I would say number one in Asia has been India and the rollout of their trade receivables discounting system, which was implemented by the Reserve Bank of India. So rather than try and more or less mandate technology or any kind of specific structure, they focused on the key components that they could standardize to make a supply chain finance ecosystem successful. And that started with, one is they standardized the KYC that was needed for counterparties to come onto supply chain finance programs. So this is one issue we see in markets where every bank will have their own differing levels of KYC, and some banks will often apply the normal KYC measures of a new client opening up an account, which you don't need a lot of that if you're doing a basic counterparty KYC for a supply chain finance program. So this can standardize the KYC processes, not only where they're transferable across multiple lenders on the system, but also it allows a third party to conduct these KYC checks for all lenders that are participants on this system. They've implemented connectivity to databases within the country that ensure there's no fraudulent invoices looking to be financed. So these systems can connect to a VAT database, an e-way bill platform, where these checks can be done. Pre-agreed documentation, this also is very key. So when this initiative was rolled out by the RBI, they put all these pieces together and outlined 3 technology providers that could support this system. So they held the back-end asset registry database, but they allowed 3 technology providers to plug into this and provide all of these services. And one of the key things, like I said, with the KYC, is they had pre-agreed documentation. So the Reserve Bank of India said you had to use these documents and no changes could be made. So that makes standardized documentation for all of the banks, all of the clients. There's no need for negotiation, and makes it, again, easily transferable across clients, banks, programs, etc. Supported also by digital signatures. So like I said, there's also an internal asset registry. So all of these 3 systems connect to that asset registry via blockchain. So if an invoice is sold on one platform, it would automatically be logged into that asset registry. And then if that invoice was tried to be sold on another platform, you would obviously get a fraudulent hit because it would be connected to that asset registry accordingly. And then automating all the payment systems. So this, from a technology and a regulatory standardization standpoint, this has made major strides within India on rolling out this program. And one of the other key things they did was outlining that any corporate, so buyer anchor in this case, with turnover over 5 billion rupees, they had to start putting invoices for their SME and MSME suppliers on this platform, on the TREDS discounting system. So that was a major move as well. So it forced all of these invoices to be visible on the system, whether they're getting financed or not, and at least allowed all of these invoices to be entered into the asset registry. So there's some key drawbacks or potential improvements that could be made to the TREDS platform. So really, it was only made for banks initially. It was not inclusive of non-bank lenders, although that is changing. It's been restricted only to MSME financing of suppliers. So you're leaving out a large market of SMEs and just larger corporates who may want true sale financing. So financing on invoices that's not considered debt. It was restricted to 3 technology providers. So Bank of Thailand has gone a step further with that, which I'll talk about shortly. And the only product they rolled out initially was a confirmed payables model. So they haven't tackled distributor finance or seller side financing. They haven't tackled inventory financing. So those are things I think will come down the line, but could definitely help. And then just the level of fraud in India has caused major issues with credit insurance. So credit insurance is not available on the TREDS platform either. So that would be a major part of that ecosystem that Jen Chang was mentioning that would really help implementation of TREDS as a whole. And then Bank of Thailand really looked at TREDS as their model to roll out as well. So this is in its nascent stages, but it's following a lot of the same lines that TREDS did. I think one of the 2 key changes they're making is they're opening it up to multiple technology vendors. So they're providing a list of requirements that the technology vendor must provide. And then more or less any technology vendor can connect to their domestic asset registry and provide services to clients and banks and non-bank lenders. Also, they're working on a credit insurance option where the majority of invoices falling through this ecosystem could be credit insured either by private sector or public sector guarantees. So this is in the early stages, but what they're talking about and the ways they're looking at it of taking really the model of TREDS and improving on it, it's really exciting, and I think would be a key model for any any regulatory institution within any of the banks in Southeast Asia, South Asia to take a look at. That's it. Thank you.
Thank you, Cliff. You talked about the various technology options, cloud, on-premise, what's available out there, and critically the regulatory involvement, especially in India and Thailand, in jumpstarting a workable and thriving SEF environment. The late Philippines Senator Raul Roco once said, if you ask a banker what is 1 plus 1, his answer is 2. If you ask an accountant, his answer is, what do you want it to be? But if you ask a lawyer what is 1 plus 1, his answer will be, whose side are we on? The Philippines' financial and legal landscape is fortunate to have our next speaker on its side. He has advocated and continues to advocate on the side of reforms and deepening of the Philippine capital markets as former president of the Philippine Stock Exchange, the Securities Clearinghouse Corporation of the Philippines, the Shareholders Association of the Philippines, and in his role as board director in several companies in real estate development, communications, insurance, banking, and energy. He campaigned for the necessary legal infrastructure in his major role in enacting several Philippine laws, such as the Financial Rehabilitation and Insolvency Act, the Credit Investment System Act, Real Estate Investment Trust Act, Personal Equity Retirement Account Act, and the Philippine Competition Act. He champions the molding of the minds of the legal profession as a professor of law at the Ateneo de Manila University, San Beda Graduate School of Law, and the Philippine Judicial Academy. He is the Senior Legal Counsel of ACRA Law, the immediate past president of the Management Association of the Philippines, and presently president of the Financial Executives Institute of the Philippines. Giving his take on the Personal Property Security Act and the collateral registries and related issues, please welcome Attorney Francis Lim. Francis, we cannot hear. Please unmute.
Okay. Thank you very much. Okay, do you hear me now, Mitch? Hello?
Yes, we can hear you. Thank you.
Let me share my screen. No? Okay. Okay, thank you very much for this invitation. I was asked to speak on the new legal environment for movable asset financing. And we're fortunate that after years of work, I think in 2018, our Congress has enacted what is now called as the Personal Property Security Act, which became effective into law on September 7, 2018. And more than a year thereafter, the implementing rules and regulations of this new law were enacted. We in ACRA Law, I think I have two of our lawyers here who helped craft the law. We remember our team going out of town just as a service to the government, to the country, because we believe that our country needs a unified modern system, because our civil code, which is the basic law on personal property security, is I think 70 years old. You can just imagine what legacy problems have brought out because of this archaic law. The policy objectives of this law is to provide access to credit at least at the least possible cost. And when I first attended, I think it was under the Aquino administration, an FIDN conference. I remember Secretary Purisima talking about this. But it took some years. It's not unusual here in the Philippines. For example, Mitch, has mentioned that I was involved in the FRIA, or the Financial Rehabilitation and Insolvency Act. It took us 12 years to do that. I was involved in the Philippine Competition Act. It took us 23 years to do that. So in terms of timeline, I think this is one of the laws that was enacted by Congress in a relatively short period.
Francis?
Hello?
Yeah, sorry to interrupt. Could you kindly put your presentation slides in presentation mode? Thank you.
Can I ask the help of Rina, are you there? Okay.
Yes, I will share my screen.
Thank you, Francis. Sorry for the interruption.
Okay, can you next slide go to that? I think slide 3 or whatever. Yeah. Okay. This new law repeals several laws, and the screen, Arina, can you please share the screen? The civil code provisions on a chattel mortgage, the provisions of the civil code on pledges, some provisions of the Financing Company Act, and even provisions of the Land Transportation Traffic Code. No? And this is important to point out because lawyers and practitioners may still go to these laws, no, in order to advise their clients or to do their transactions. So it's so important that the practitioners, the stakeholders, know what these laws are. Next slide, please. The general rule is that this law applies to all obligations where personal property is given as a security, and that property is either tangible or intangible. I think Jinjiang mentioned that in other countries there are issues of whether or not receivables or inventory can be made subject of security interests. We had the same issues before, but that issue has now been laid to rest by this new law. But there are also exceptions. I think the law made 2 exceptions. This law does not apply to security agreements over aircrafts, security agreements over vessels or ships which are subject to those special laws, like the Civil Aviation Authority Act and the Ship Mortgage Decree of 1978, respectively. Next slide. Now, what I'd like to do due to time constraints is to give you just some of the changes brought about by this law. This law has provided or provides clarity on eligible and registrable collaterals. I mentioned some of them, the receivables, the inventory, and so on and so forth. Issues whether shares of stock can be made subject of a chattel mortgage, but now that issue has been laid to rest. Before, we had shares of stock could only be collateralized through a pledge under the civil code. A very big change that's being brought about by this law is the description of collateral. I do remember having discussions with the IFC on the ease of doing business, and we did not get a positive score on this particular matter because there is a Supreme Court decision which basically says that the collateral under a chattel mortgage must be specifically described. Again, that issue has been laid to rest by this law because description is sufficient if it reasonably identifies the collateral. Another big thing that this law has brought about is the so-called floating lien. Unlike before, security interest can now be constituted over all personal property, all equipment, all inventory. So if you are a small grocery owner, you can constitute, you can get financing for a business and just say, okay, all these goods in my store, in my grocery, are subject of lien in your favor. Next slide, please. Next slide, please. Okay. Another issue is this law now makes certain that future property can be subject to security lien. That was not possible under the old law, for example, under the chattel mortgage law, because of this so-called affidavit of good faith that was required under the old law, which basically says that the parties are constituting the mortgage over a property that is owned by the mortgagor. There's a civil code provision to that effect. That's that issue is gone under this new law. Equally important is the harmonization. No? There is now one set of law under this new law on the creation, perfection, or registration and enforcement of security interests. Unlike before, where we have to look at different laws, the law on pledges, the law on chattel mortgages, the law on the transportation law, before on the creation, perfection, registration of security interests over those chattels. Another thing, and this is a very big thing for lenders, unlike before, for example, if a person pledges his shares of stock in a company after default, the bank cannot foreclose the mortgage by just selling it. The bank has to go to do it via public auction. Another thing is the lender can retain the collateral. No? Of course, he has to make a proposal, no, to the grantor or the debtor. Next, please. Okay, the most important thing that this new law brought about is the nationwide and centralized electronic registry in the land transportation registry. Under the chattel mortgage law, under the old law, for example, the security interest over a chattel must be registered, physically registered, in the place of the residence of the secured creditor and the place where the chattel is located. This is now gone, and we will hopefully, and I think I saw in the program that today will be the launching of the nationwide electronic registry. Okay. Now, my other slides contain the details of the new law, but what I'd like to do, okay, this is another one. No? In terms of priority, again, this is it's now much simpler. No, priority will be determined by registration or compliance with registration or other modes of perfection, without regard to the order of creation of the security interests and fraud and liens. For example, there were fraud cases in the past where the both debtor and creditor would antedate, no, their security interest, their collateral agreement, and claim some form of security. But that is now done because the new law now expressly provides that it is the time of registration or compliance of other modes with other modes of perfection that is relevant without regard to where the security interest has actually been created. Another thing that this new law brought about is the provision of deficiency claims. Under our civil code, for example, in case of pledge, when the creditor sells the thing pledge, if the value of the sales proceeds is less than the amount of the debt, then the creditor cannot claim the deficiency from the debtor. And I think that that's why even if there were pledges over shares of stock, over property, lenders, banks, for example, did not really resort to foreclosing the pledge because of their inability to claim for any deficiency from the debtor. Next, please. Another big thing that from a legal standpoint this law does is that a security interest over personal property is effectively a continuing guarantee, where even if the payment if the debt that is secured is paid, the security continues if there is a commitment to extend further credit. As I said before, this was not possible under the old law because of that affidavit of good faith in case of chattel mortgage, where both the creditor and the borrower, what do you call this, certifies under oath that the security is being given to secure, no, to guarantee the payment of an existing obligation. But here, under the new law, a mere commitment to extend further credit is enough to make the security agreement continuing in force and effect. Next, please. Okay, these are now the details. I will not go over them, but what I'd like to do now is to give you some insights, though, on what I think should be done. I've been into a lot of lawmaking and rulemaking, My experience is that there are laws, there are rules and regulations, but the main challenge is how to operationalize and utilize the law and regulations. And I believe that this is the same challenge that's facing this PPSA. For example, the PPSA was enacted way back in 2018, but it's only now that the Personal Property Security Registry will be launched. So I think we've lost more than 2 years. I'm not blaming anybody, but that's the way things are. No? Another challenge that is facing the implementation of this new law, very desirable law, if I venture to say, are the legacy problems brought about by an archaic legal framework under our civil code. For the information of everybody, our civil code was enacted way back in I think 1950. So it's more than 70 years old. And of course, because it's an old law, there are practices that more or less have been made permanent. And because of this, I think there will be operational difficulty to transition from the old legal system to this new legal system. For example, I think this has been mentioned by Keng Lee. There's a bias in favor of big borrowers. I dare say that because of the very, very archaic law on chattel mortgage and personal property, there's bias in favor of real property. And we really have to fix the mindset of our lenders in order to transition to this very favorable legal environment. Because of that, of this archaic legal system, our lenders are not very well prepared to take on the issues, to take advantage of the new SCF market that is envisioned to be developed by this new law. For example, some of our speakers mentioned about technology problems, but I'm glad that these technology problems can be easily solved by leapfrogging into new technologies without much effort and with lesser cost. I think that's what I understand. So my insight here is that there is this new law, there are rules and regulations, and the PPSR, the registry will be launched. But I think we have to have stakeholder education, okay, on the part of the borrowers, on the part of the lenders, for the regulators, for the lawyers, for the accountants, for the insolvency practitioners, and our courts of law, especially our courts of law. Because my own personal experience that if the courts do not implement the law as envisioned by Congress or by for example, by ASU, worker of the law, I think it will not produce the effect that the desired effect. No? There's a huge potential for the SCF market, no? Which in my mind requires a whole of nation approach due to the legacy problems that I pointed out, and because as was pointed out in one of the presentations, we're lagging behind, no, in the development of our SCF market. So that's all. I'll end here because of the time constraints. I would be glad to answer questions during the open forum. Thank you, Mitch.
Thank you, Francis. Thank you to all the speakers. The first question, actually, you already answered towards the latter part of your presentation, talking about the challenges in implementing the PPSA or the collateral registry. So I'd like to ask that same question to Jin Chang. No? Based from your perspective, from a bigger macro view, what do you think is critical to ensure that a collateral registry is able to work well and to ensure that it actually mobilizes access to finance for MSMEs? Jin Chang?
Thank you, Mitch. So first, let me congratulate the Philippine LRA, Land Registries and Agency, for making the collateral registry on board. So it has already been launched about 10 days ago. So I understand later on there will be a virtual ceremony on this. So it has been a long effort and many people has contributed to it. So congratulations on this important milestone. So collateral registry actually itself in an operational sense or in an IT sense is not a hugely complicated thing. So there have been many experience internationally, and actually UNCITRAL has a guide on the collateral registry. So typically the difficulties are actually with the law. Because the collateral registry is just like an IT system where you can file your security interest in the system and get the priority. But this will need a good law to support it. And fortunately, in the case of Philippines, the PPSA is actually, I would say, a very good law overall. So, and the other thing, other difficulties normally across the country is with institutional arrangements. So before a centralized, single and web-based registry, typically in those economies, they have some decentralized registration with almost zero volume. Still, some agency will resist because this may affect their power or job or whatever. So again, it's more difficulty of law and institutional things, not the IT system or the operational things itself. Thank you.
Thank you. My next question is for Lee and Cliff, and this is about technology. You mentioned about being able to avail of the technology platform, whether in-house or outsourced. The question is, are these technology platforms available to smaller banks, not just the tier 1 banks? And if so, in what context? Lee?
Okay, the technology that's available is for everyone, even fintech company will be able to subscribe to technology. So it is not just only available to big banks. Big and small banks can avail to this technology.
Cliff, your own take?
Yeah, I would agree that the technology overall is available, but I think when you look at certain technology providers out there, some of them will have restrictions on certain markets. So we've gone to Pakistan, for example, and they were talking about bringing in a prime revenue or Demica, which these are major large-scale platforms really focused on the North American and European markets, and they don't have much support in Asia, or definitely not specific experience in any market like Pakistan. You do have technology providers like Kang Leon's HPD solution. Like us, we have a cloud-based solution. There's others that their focus is developing markets and working with smaller banks, working with non-bank lenders, and helping develop those ecosystems from the ground up. And often those types of solutions really have a breadth of products that the larger technology providers don't really focus on.
Thank you, Cliff. This is for Francis. Francis, you talked about the challenges in terms of executing the collateral registry. As president of Phoenix, how can we help and partner with government to educate stakeholders on PPSA so that we are able to address some of the challenges you mentioned?
In fact, I was thinking about that, Mitch. No? We may want to consider, and I will talk to the committee, a relevant committee in Phoenix, to have a seminar or a workshop for all stakeholders. No? Because, as I said, education is very important here. It's something new. It's a departure from the old system, which we are very much used to. And, this is stuck to the past mindset. No? Must be undone. Because I see, I hope it doesn't happen. Lawyers, even bankers, accountants, really arguing, no, that the PPSA is just what do you call this? An improvement of the old system, and they may tend to do things the way they have been doing things, and that will not achieve the purpose or the objectives of the law. When I was studying this, thanks to my two colleagues in Acrolo, Lynette, I think she's here, and Rina, there were a lot of questions in my mind as a lawyer. No? And, you know, we are basically a litigious society. And unless we have a mindset that is welcoming to this law, I think there's that tendency to go back to the old system. And we in Finex can, I think, contribute. Unfortunately, because this is a new law, there are not many experts, I think, and I would really challenge the law firms, the accounting firms to develop their own internal expertise. Because as these stakeholders develop their expertise, they would, in the long term, help the whole market. I think Jingyang made many good points as to the potential of a huge potential of this market. Am I right, Jingyang? And the experience in other countries have shown that it can be taken advantage of, especially in the case of the Philippines, where as President Jeng has pointed out, 99% of our businesses are from the MSME sectors, providing more than 60% of the employment and more than 35% of the GDP. So, you know, we have to help the whole system. And that's my own personal take there. And to the extent that we in Finex can do our share, why not?
Thank you, Francis. This for Jin Chang. Jin Chang, from your more macro perspective, looking at different economies, banks tend to be a laggard in terms of developing SCF platforms. There's a comment here where banks prefer a closed loop, one-to-one relationship. Could you comment on how that can be reversed in developing a functioning SCF ecosystem in the Philippines or in other countries?
So thank you for the question, and that's a very good question, but it's also a very challenging question, I would say. So because banks are used to do the things their own way, right? So as I say, that if you do it on one-to-one basis, that's one way of doing business and finance, but there are other ways. Financial leasing is another way. Supply chain finance is another way. So for the banks to really take on board, I think two things are important. Number one is that the banks need to be convinced that they have some gains from it, they have some profit to be made. And the advantage is that if you do it in an SCF way, there are multiple benefits. One benefit is that you can wholesale to the clients in a value chain instead of looking for them, convincing your client one by one, right? That's an obvious benefit. The other obvious benefit is that you can leverage the information and incentive from the big buyer and the big seller to monitor and control your clients. So there are multiple things that I don't want to elaborate here. So this is one aspect. The other aspect is actually the government, which often I think is not well understood. So sometimes the government, not only financial regulator, but other branches of government, they can help to push for these kind of things. I know at least one economy where the financial regulator has specific targets for the banks to reach the MSMEs. And medium and small banks, or even large banks, they have great difficulties to meet the target. Then what do? They leverage third parties, like third-party e-platform, third-party supply chain management platform, or whatever. Third-party payments company, there are some discussion in the chat about saying, oh, let's leverage the payment in China also. Yeah, payment is not just for the payment. Payment is basically to link out the chain and to provide the information. So then the government put the efforts to develop all those third-party services providers, so that banks sees that it's actually relatively easy to do things in a wholesale way, and many jobs are done by the third parties. But unfortunately, I will say that most government in the region, they are not active in this space, probably they had not fully understood it. Thank you.
Thank you, Jin Chang. And on that note, we only have a few more minutes. I would like to ask Lee, Cliff, and Francis in order, just key thoughts, something you would like to, key stakeholders in promoting supply chain finance. From yesterday, the Philippines has made great strides in providing the key infrastructure. We have built it, so to speak. Now the question is, will they come? So Lee, Cliff, and Francis, your just quick thoughts to stakeholders to ensure that we can really operationalize a supply chain finance relevant to the needs of MSMEs. Lee?
Okay, Philippines is already ready with your laws. And as I've mentioned in various FIDN seminar, unlike many Asian countries, you are proficient in English. Because of your proficient in English, you are able to learn from the best. That's one. So you are better than many Asian countries in this respect. And second, the availability of cheap technology, go and look at it and see how best it can help you. Do not look at implementing the technology yourself. It will take a long time. You will not be able to get the best analytic, get the best from the world. So get the best from the world. There are many systems available. Go and take a look at this and see which one you want to choose.
Cliff?
Yeah, I think you hit the word on the head. Operationalize. That's the next step to take it forward, and really where we see banks and markets at these stages, you've got to provide those tools to help them operationalize it and take it to the next step. So in my mind, it's taking it from the strategy level. Now, how do we implement these programs? So like we saw with TREADS, providing standards around KYC, providing legal document templates that these banks can use and the structures that they can easily understand, providing them either technology options or a list of technology requirements that they should be following if they're going to go and buy their own solution or build their own solution, and how that solution would connect to a PPSA registry database and things of that nature. So I think that's really the next steps on how to operationalize this is really hand holding through some of those major roadblocks and hurdles that the banks are going to see.
Francis?
Well, the questions that are not, and what big key question that's normally asked when there is a new law, a new reform measure is, what's in it for me? Okay. So, and if I give, I'd like, if advice on, what I'd like to say is, let's disconnect ourselves from the old system and practices and connect ourselves to this new system, because there's so much potential for all of us.
Thank you all panelists. Thank you for the questions. Thank you, Jin Chang, Lee, Cliff, Francis. And this is a wrap for this session. At this time, we would like to acknowledge the presence of the Secretary of the Department of Finance, Republic of the Philippines, Mr. Carlos Dominguez. Domeng, back to you.
Thank you. Thank you, Mitch and panelists, Mr. Jin Chang Lai, Mr. Keng Leong Lee, Mr. Cliff and Trekin, and Attorney Francis Lim for that interesting session. We now come to the much-awaited portion of today's program, which is the virtual ceremonial launch of the Land Registration Authority's Collateral Registry. As many of us are now aware after that very exhaustive presentation of Attorney Lim, Republic Act number 11057, otherwise known as the Personal Property Security Act or PPSA, was signed into law in August of 2018. And PPSA aims to promote economic activity by increasing access to least cost credit, particularly for micro, small, and medium enterprises, by establishing a unified and modern legal framework for securing obligations with personal property. It aims to strengthen the secured transactions legal framework in the Philippines, which shall provide for the creation, perfection, determination of priority, establishment of a centralized notice registry, and enforcement of security interests in personal property and for such other purposes. In this connection, and again as mentioned by Attorney Lim, the implementing rules and regulations of the PPSA were rendered effective in August of 2019, and these rules required the Land Registration Authority to establish the LRA Collateral Registry. Because of the current pandemic, we shall have this morning the much-awaited virtual ceremonial launch of this registry. Please allow me now to call the heads of the key agencies that led this effort. First, we have none other than the Secretary of the Department of Finance of the Republic of the Philippines, the Honorable Secretary Carlos G. Dominguez. And we also have with us today Administrator Renato D. Bermejo of the Land Registration Authority of the Philippines, who will deliver his remarks. Sirs, you have the floor. Is Administrator Bermejo with us?
Hi, sir. I am present, sir.
You now have the floor, Administrator Bermejo, for your remarks.
Okay. Good morning, Secretary Dominguez, Yusik Beltran. Good morning, everyone. First of all, we would like to thank our partners, the people and the organizations who help us realize this remarkable endeavor. Today, the LRA, together with our major partner, the Department of Finance, would like to present to you the Personal Property Security Registry. The setting up of this registry is indeed another milestone, not only for the LRA, but also for the government. With your support, we are hoping that we will be able to achieve our objective of making this registry an instrument for growth of the low-income sectors through access to least cost credit, most especially during this time of pandemic when everyone grapples for much needed financing. The role of this registry is administrative in nature. By registering a notice or refusing to register a notice, this registry does not determine the sufficiency, correctness, authenticity, or validity of any information contained in the notice or the validity of the security agreement. It is the responsibility of the lending entity to check the validity of the information to be provided. This registry is new and may not be perfect. There may be flaws or some lacking points, but together we can have it perfected. To end this note, the LRA and the Department of Finance request your continued support to this registry and to the PPSA as we implement this game-changing law. Honorable Secretary of Finance Carlos G. Garcia Dominguez III, sir, we extend our appreciation and thanks for your support to the LRA in the establishment of this registry, the Personal Property Security Registry. Thank you all, and please stay safe. Good morning.
Thank you, Secretary Dominguez and Administrator Bermejo, for honoring us with your presence for the launch of the LRA Collateral Registry. We now come to session 2 for today's part of the conference. Please allow me now to introduce the moderator for this session. Assistant Secretary Maria Teresa S. Habitan of the Department of Finance of the Republic of the Philippines. At the Department of Finance, Assistant Secretary Habitan covers the fiscal policy and planning initiatives with focus on the tax reform program, revenue forecasting, and fiscal programming. She chairs the multi-stakeholder group of the Philippine Extractive Industry Transparency Initiative and has previously done work on issues relating to government corporations, privatization matters, and microfinance policy. Ladies and gentlemen, it is an honor to have with us today Philippine Department of Finance Assistant Secretary Maria Teresa S. Habitan. Ma'am, you have the floor.
Thank you, Doming. Good morning to everyone. During the first session, we listened to the current landscape, the SME financing landscape, and how new technologies are helping the propagation of more financing for our MSMEs. Now we move to how the status or the state of credit infrastructure reforms as applied in the Philippines, and what else can we do moving forward. So this FIDN conference hopes to bring together the relevant partners and beneficiaries in a dialogue on the way forward and equip them with critical lessons to explore alternative routes of financing for MSMEs and to operationalize credit infrastructure reforms. It has been mentioned several times in this forum that in the Philippines, prior to the pandemic, more than 99% of all businesses were MSMEs, which generated more than 5 million jobs, or 62.4% of total employment. So we can say that the economy is resting on all of these MSMEs, which are also very fragile, and especially made even more fragile because of the COVID-19 pandemic and the subsequent community quarantine restrictions, which have crippled most of our economic sectors. We also saw just now the virtual launch of the PPSA, the registry for personal security, and this has been a reform long time in coming. The pace of reforms can sometimes feel incremental, but it happens. Our task now is how to make this move faster with all the challenges that come, as some are expected and many are not. To provide us with an overview of how to look at these reforms in the financial sector for MSMEs, we have Mr. Christopher J. Wallert. He has been a long-standing presence in FIDN conferences. Chris is the business leader for the commercial distribution finance platform in Asia for Wells Fargo. And in this role, he leads the inventory financing and cross-border factoring business, serving multinational manufacturers across a variety of industries in coordination with the commercial distribution finance platforms in Wells Fargo globally. Chris has decades of experience in the fields of commercial lending, inventory finance, and factoring. So Chris is also an active member of the Asia Pacific Financial Forum, part of the APEC Finance Ministers process, where he serves as the leader for secure transaction reform, for the Financial Infrastructure Development Network launched in November 2015 as part of the Cebu Action Plan. Chris, please have the floor.
Great. Assistant Secretary Havitan, thank you for the kind introduction. Good morning, everyone, and it is a pleasure to be here virtually and speak at this 9th FIDN conference on credit infrastructure. When FIDN started 5 years ago here in the Philippines, one of the pillars was to enhance the access to finance for MSMEs through the reform of credit information and the Secured Transactions Law and Regulations. This goal has been embraced by the Philippines with a variety of reforms to facilitate and enhance the access to finance for these MSMEs. This is easy to see why these things have been accomplished with such a broad range of distinguished guests here supporting today's event and the reforms from the Department of Finance, the BSP, Department of Trade and Industry, Land Registration Authority, the Securities Exchange Commission, and FINEX, as well as so many others. As we know, many tangible milestones to this goal have been accomplished. We have spoken of many of these during our discussions yesterday and today. We have explored the continued progress in credit information, talked about microfinance and insurance, and the development of the credit risk database, all of which work together to create an enabling environment for MSME finance. Today, just a couple of minutes ago, we have jointly celebrated one of the most significant milestones in this journey, as Secretary Dominguez and Administrator Bermejo announced the launch of the online collateral registry. At such a milestone, I thought it would be helpful to take a look at key enablers of inclusive movable asset finance and how the PPSA and collateral registry supports this inclusion. Back in 2016, at one of our first FIDN conferences, I had outlined 3 key elements that I felt were necessary to ensure that secured transactions reform efforts supported MSMEs and not only large enterprises. Those 3 elements were transparency, efficiency, and enforceability. So let's talk a little bit and see how the Philippines has done on these 3 elements with the PPSA and the collateral registry. Transparency. This means that the security interest is accessible and that the secured creditor can readily see and assess all competing interests related to a borrower and their assets. A fundamental tenet of modern secured transaction systems or movable asset lending systems is the clarity of who has rights to what collateral of a borrower, whether this be inventory, equipment, accounts receivable, or other assets. If you have a system where there are a myriad of places in which a lender's interest may be reported, or there are secret liens, then this becomes more difficult and time-consuming to confirm your interest, to understand your position in the collateral of the borrower, and as a result, you have a continued exclusion of MSMEs to access appropriate finance to grow and build their businesses. However, the PPSA provides for a consolidated view of the security interest against the borrower's assets, with the exception of ships and aircraft, as Attorney Lim just noted in the prior presentation. These allow for the lenders to quickly and confidently understand their position in the collateral. And the registry provides for these interests to be centrally located, online, and searchable to allow for full transparency, thus fulfilling the first required element. The second element is efficiency. In other words, is the process to register or monitor a security interest in movable asset collateral simple, fast, and cheap. This is one of the most significant barriers to MSME finance, access to finance in many markets. Oftentimes, the process to register a security interest is time-consuming, complicated, requires specialized legal work or notary public. Sometimes an in-person appearance is required to complete the filing, and all of this results in significant costs. And when this happens, access to finance for MSMEs is cut off because the transactional costs are too expensive, given the size of the average MSME loan. It's just simply not economical. Lenders cannot make a profit by doing this business at a reasonable interest rate, and as a result, do not offer or extend these loans. The PPSA, and most importantly, the new online collateral registry, embraces the best practices of a modern, inclusive, secure transaction system. It is efficient, filings are relatively simple, online, and are notice-based. The process to file is quick, and searching for your interest or others' interest in the same assets of the borrower is simple. So the second element is fulfilled. Finally, the third element is enforceability. If a lender is going to confidently lend on movable assets, the lender must have confidence that in the event of a default, they have the ability to recover and liquidate the collateral of the borrower. It is unfortunate when this occurs, of course, but it is a necessary element of the system to unlock the ability to lend on movable assets. Consistent with modern secure transaction regimes, the PPSA provides for various avenues of enforceability, including repossession of the collateral so long as there is not a breach of the peace, which would be no act of trespass, physical violence or intimidation from the secured creditor, or participation outside of a court order by law enforcement officers. So the collateral may be, additionally, the collateral may be repossessed without the knowledge of the borrower, again, without breaching the peace. The PPSA also provides for specialized rules for certain types of collateral, for example, depository accounts, bank accounts, or accounts receivable. And in the event that repossession cannot take place without a breach of the peace, there is clear recourse to the court system for recovery of the collateral on an expedited basis, as well as a judgment of opportunity for judgment on any deficiency balance left after liquidation of the collateral. Equally important, these rights are protected and offset by protecting the rights of the borrower under the PPSA, including specified requirements for the secured lender to adhere to with regard to both repossession as well as disposition of collateral. So the third element is largely fulfilled, although we obviously anticipate actual court decisions as we progress to further build up the level of experience and comfort on enforceability as usage under the PPSA takes shape and expands. So transparency, efficiency, and enforceability. Each of these three key issues to unlocking MSME access to finance has been addressed with the PPSA, the implementing rules and regulations, and now are able to be put into full practice with the launch today of the collateral registry. The Philippines has made tremendous progress in improving the ability to expand access to finance for MSMEs, but the work simply cannot stop here. We have really just put the tools in place, but now need to learn how to use all of these tools together to create an inclusive environment for MSME finance. So the tools are there, available for the industry and for MSMEs to start to learn and to develop financial products secured by movable assets, whether this is supply chain finance, warehouse finance, inventory finance, factoring, leasing, or the like, and you heard about many of those in the earlier presentation. It's supplemented by the progress that's been made in credit information systems and credit bureaus and the credit data project that's underway. So this collateral registry launch is really just the end of the beginning. Now the real work starts to help lenders understand, learn, and work with PPSA and with the collateral registry to expand access to finance via continued capacity building that experience, building that knowledge and capability. And I know that, on behalf of APFF and FIDN, we certainly look forward to continuing to work with the broader community in the Philippines to build this capacity. And with that, I thank you for the opportunity to speak here today, and congratulations to the Philippines once again on the launch of the registry and for implementing the PPSA, and I look forward to many successes as you progress from here. Thank you.
Thank you, Chris, especially for checking off all the boxes for PPSA in terms of transparency, efficiency, and enforceability. And we certainly hope that we can make this work for us now and in the future. So MSMEs are, as I said, the economy rests on this backbone of MSMEs in the Philippines. But we know that MSMEs are often not very attractive clients here in the country for our bankers, who sometimes can be described as wearing blinkers and will not recognize the attractiveness of MSMEs for bank financing. Now, to talk to us about the status and state of MSMEs in the country is somebody who has been working on micro, small, and medium enterprise promotion and development starting in the early 80s as a scholar, a Masikap scholar, which provided technical assistance in the preparation of feasibility studies for loan applicants. He also has work experience with various international organizations for projects on enterprise entrepreneurship development in the Philippines and other Southeast Asian countries. Jerry Clavesillas has been the Philippine official representative to the APEC SME Working Group and the ASEAN Coordinating Committee on MSMEs since 1996, so from the start of APEC. So he is now the director of the Bureaus of Small and Medium Enterprise Development of the Department of Trade and Industry. Director Jerry Clavesillas. Hi, Jerry.
Oh, thank you very much, Secretary. It has been a long time that we have seen each other at the IGLF Technical Working Group. Now I'm very glad to be part of this panel to present to everyone this morning the status of our credit infrastructure reforms in the Philippines as embodied in our current MSME development plan. So let me just share with you my screen. Sorry. As I mentioned, the access to credit is one of the strategic goals of our MSME development plan. And it's one of the strategic goals actually of the first area, which is business environment. So the strategy for our MSMEs to be able to access finance is embodied in this plan as outlined. It aims to simplify and streamline the loan procedures now by the banking sector for MSMEs that will make the various financial facilities accessible to our MSMEs at the ground level while equipping our MSMEs with the knowledge and other capacity building in order for them to access financing from the financial institutions. So these are now the action agenda on access to credit or finance, or simply we call this money because we have the 7 M's in the Department of Trade and Industry, and one of those M's is money. So it's addressing the operational and policy issues concerning access to finance of MSMEs. The first action item here is to undertake the capacity building program. So there are now various capacity building activities that are conducted by the various providers and enablers in the country that aims to capacitate our MSMEs access these various financial facilities. And the second one is to implement a system that will standardize issues and forms of these various financial facilities. I will give you the details later. And then the third one is the review and addressing the policy development concerns. So this is to strengthen or reform various institutional structure and mechanisms for MSME finance, as well as the establishment of several fund facilities, particularly now that we are under the pandemic. Let me just give you the snapshot of the status of MSME finance in the country. This is our data taken from the BSP. So we can see here that the share of MSME loans to the total business loans is quite low as compared, of course, to the total business loans that I have said. So starting from 2014 to 2019, the share of the MSME loans compared to the total business loans have been declining, and it has dramatically declined actually in last year's figure simply because of the pandemic. So we can also see in the disaggregated figure here that the exposure to the micro enterprises is bigger compared to the exposure by the banks to the small enterprises and the medium enterprises. So this is also a good indicator that banks now are opening up to micro enterprise lending. Unfortunately, for last year, because of the situation, it also declined. On the other hand, we are also glad to be able to get the data from the Microfinance Council of the Philippines, wherein the various MFIs or microfinance institutions are also providing financial interventions to our micro enterprises, including those in the informal sector. So the total gross loan portfolio last year was almost 50 billion pesos. There's a slight decline from 2019. In spite of the situation, the 2020 figure is not really bad as compared to the previous years. So it has been increasing since 2015 up to 2019 with a slight decline or decrease in 2020. And the number of the active microfinance clients totaled to almost 6.7 million. We are not just sure if these are unique clients or these are the transactions that are filed with these MFIs over the years. So it has been increasing from 3.6 million in 2015 to 6.7 million last year. So this is a good figure to tell us that our micro enterprises are likewise also accessing the established financial institutions, no, not only the banks, but even the microfinance institutions that are providing these interventions to them. Also, we would like to inform the participants today that there is also this collaboration by the DTI with the Bangko Sentral ng Pilipinas, particularly on this demand side survey that is being conducted now by the Asian Development Bank and the Bangko Sentral, that is expected to bridge the information gap by generating insights and more granular data on MSME financing. So this is a current undertaking by the ADB and the BSP, which is also being supported by the DTI. The second one is the standard business loan application process now that is also being undertaken by the BSP. So this aims to standardize the business loan application forms by the various financial institutions that provide financial facilities to our MSMEs. So there are other players also that are involved here, not only the financial sector, but even those in the regulatory sector that also oversee the operation of some of our financial programs in the country. Also, we are happy to note that presently there is this Deliver project of the USAID that aims to create an ecosystem that will bring together the knowledge to SMEs on how to explore various routes of financing and how to enhance bankability. Its goal is to establish a one-stop shop that will provide access to technical assistance, mentoring, and funding matches for SMEs and startups to make them more bankable. So if you can see here, it is entitled MSME Startup Contest because this is just the preliminary activity that will be conducted by the PSE together with other players to encourage our small and medium enterprises, particularly to join the stock exchange. So in as much as most of them cannot come up with the basic requirements of the stock exchange, it is a must that they must have some mentors or sponsors So there is this strategy now that is being developed by the USAID, by this Deliver project of the USAID. So we hope that this will likewise result into more access to credit by our small and medium enterprises. Also, as already mentioned earlier, particularly by Attorney Francis, the DTI supports the implementation of the Personal Property Security Act, and we have just witnessed earlier the launching of the Personal Property Security Registry. So we hope that many of our MSMEs, including of course the farmers and the fisher folk, will be able to avail of the needed financing through this intervention that has just been provided by the DOF together with our LRA. Also, there is this proposed bill now amending the Magna Carta for MSMEs. It's a substitute because there are various bills that have been filed in the Congress amending the existing Magna Carta for MSMEs. We all know that the Magna Carta for MSMEs provides for mandatory allocation to our mandatory lending provision to our MSMEs for 10 years, and it has expired in 2018. So the previous provision was 8% of the total loan portfolio of our banks must be lent out to the MSMEs. Another 8% goes to the micro and small enterprises, while the 2% goes to the medium enterprise. Now in the proposed bills, there is this proposal that the total of 10% can be for the entire MSME sector for as long as not more than 1% will be provided to the medium. So in short, 9% shall be for the micro and small, while maximum of 1% for the medium. But on the other hand, maximum of 10% can also go to the micro and small if the banks see that they are worth lending to. So there is also this warehouse receipts bill now, which we are likewise also supporting. We hope that this will be passed into law soon, and we hope that all of these various legislations will definitely provide more access to our MSMEs. Also, we are happy to note that the Credit Information Corporation database remains the largest and most comprehensive database in the country, covering almost 36% of the country's adult population from across 534 financial institutions, submitting data to the credit registry. So recently, they have this CIBI app, which is developed by the CIC Credit Bureau, CIBI Information Incorporated, that provides credit histories and an identity verification process. This mobile application will help MSME borrowers access their own credit information through their mobile device, so they can determine with the range of their bankability through the information that they have uploaded in this app. So this will also help out our MSMEs also evaluate their bankability. So we hope that this will likewise also provide more access to our MSMEs in the future. Also, we have now this existing financial facility being undertaken by our Small Business Corporation attached at the Department of Trade and Industry. So there is now this big funds that has been allotted for lending to our MSMEs. But specifically during at the start of the pandemic, they have this so-called CARES program that has been called out from the total funds of the Small Business Corporation that is intended to be provided to those MSMEs which have been affected by the pandemic. And then also under the Bayanihan 2, they were also able to get funding from that act, wherein also about 10 billion of the total funds is also intended for lending to the MSMEs. So these are now the existing financial facilities under the Small Business Corporation that is also provided to our MSMEs be able to recover from the onslaught brought about by the situation starting last year. Also now we are glad that the Small Business Corporation is also engaging into the so-called platformication, wherein their goal is to be a fintech government financial institution with the fully online loan processes. So among the features of the plan includes the KYC, payments and collections, some information on the promotions by various partners, and then some news and updates pertaining to financial facilities, as well as the potential loans and investment opportunities for them whenever they are intending to invest the money that they have borrowed from the corporation. So all of these interventions are now aiming to facilitate the access of our MSMEs to more credit in the country. And we are very glad that the various agencies, partners, particularly in this financial infrastructure development network, are likewise working out for the promotion and implementation of the various interventions of these different partners that will also aim or help out rather our MSMEs to become to have more access to these various financial facilities. So with this, I would like to end my presentation, and I hope I was able to give you the total picture of our MSME infrastructure and credit. Thank you very much.
Thank you, Jerry. Also for introducing a new word this morning to me, platformication. Okay. And please prepare yourself. There's a lot of questions in the chat box. I think it's all addressed to you. Now, let me move on to our next speaker, Attorney Robert Nomar Leyretana, or DepBob. Started his career in LRA as chief of the law division in 2003, and now he serves as deputy administrator. He also had the unique opportunity to serve before as the officer in charge of LRA from August 2016 to June of 2017. Prior to his stint in government, he had an extensive private practice in the field of land titling from 1994 to 2002. And recognizing his competence in public governance, the Office of the President conferred him with the rank of CESO 2, the second highest rank given to a career government official. He provides his expertise in the field of land registration. He is an MCLE, Mandatory Continuing Legal Education lecturer on the subject in the UP College of Law, in the Ateneo Law School, the De La Salle University School of Law, University of the East College of Law, and the New Era University School of Law, as well as the Arellano Law School. He also is a law bar reviewer and part-time law professor. So you can see from his experience, he is really a most sought after lecturer in the field of land titling, locally and also in foreign lands. He has been invited to speak in international fora, notably in the World Bank Annual Conference on Land Governance and Poverty Alleviation. DepBob, you have the floor.
Thank you. Thank you for that nice introduction, Assistant Secretary Habitan. Can we request the OF to share my PowerPoint presentation? Yeah. Can we focus on slide number 4? I can skip all the other slides, no? Yeah. As I mentioned, first of all, I would like to good morning to everyone, and most especially to DOF Secretary Dominguez and our administrator, LRA administrator, Attorney Renato Bromero. And thank you for giving me this opportunity to give you a brief update of what is now the status of the development of the PPSR now. As mentioned a while ago by my esteemed professor in law, Attorney Francis Lim, and my fraternity brother, there are a lot of the legal framework by which the PPSA was hinged and the legal provisions, I will no longer be able to discuss that. But I would like to focus on one of the most, shall we say, game changers initiative of the PPSA is the establishment of the notice-based registry. The law actually speaks of notice registry. Sometimes it is loosely called as the personal collateral uh, property registry. But for purposes of LRA's establishment, in terms of the mandate of the LRA, we dubbed it as the Personal Property Security Registry in accordance with Section 26 of the law. Okay. Now, why is a PPSR a game changer? And why is LRA sits in a more or less pivotal role, or shall we say, a fulcrum of the operationalization of the PPSA? Because the PPSR, or the Personal Property Security Registry, serves as the, or provides the the substance and form by which all the initiatives and reforms as introduced in the new law are provided. So LRA, in its mandate as the manager of the registry, sits as the fulcrum, no? Nasa balat, nasa ano siya, nasa gitna siya. It has a central role in the creation, all right, and the establishment of a notice by which the created, perfected right under the secure transaction law is established. Next slide, please. Now, as aptly put by the earlier esteemed speaker, Mr. Lee, by transitioning from a, shall I call, a Jurassic law or the Jurassic system of chattel mortgage registration. Why I say Jurassic? Because do you know that the chattel mortgage law was actually enacted sometime in 1906? Although the system by which chattel mortgage are registered have been implemented or incorporated in a latter law, which is PD 1529, which provides for the registration of the chattel mortgage law, which is relatively old because it was established in 1978. So by transitioning from a Jurassic system of a manual chattel mortgage registry into an LRA online property security registry, the earlier speaker is correct that we are leapfrogging into a new technology. As he mentioned earlier, he aptly said that a leapfrog into a new technology can be considered as you are the best in class. We are not saying that LR is the best in class, but what we are trying to establish or come up with as mandated by the law is just we are trying to approximate, no, to be the best in class. Okay, next slide, please. Next slide, please. All right, so basically the mandate of the LRA in relation to the PPSA is to administer and establish the Personal Property Security Electronic Registry. We will provide the electronic means by which registration and searching, okay, highlight the searching of notices made available for the public. Now, this is one of the provisions of the law that was given substance in the so-called PPSR, because the one of the basic intention of the law is to provide support for credit information system. All right. Now, in the manual registration or manual registry system, the notices, the records by which these secured interests are kept by the RD are not open to the public. Okay? Now, to provide support for the reforms initiated in the credit information system is that we provide a notice search in the registry, such that if you are able to obtain a user account, okay, whether you are a client or a grantor or a grantee, then you can be able to go into the system and search the notices. So it serves as the registry serves as a whiteboard, okay? And then of course, there will be a lot of, as we go along with the system, the LRA is given the Herculean task to maintain and would perhaps in the future would have some refinements. Okay. Next slide, please. Now, what is basically the features of the PPSR? It is notice-based and not document-based. What does this mean? Unlike in the old Jurassic registry, you go to the registry, you present the document itself, and the LRA or the R through the Register of Deeds serves as the repository of all these documents, whether it involves registration transactions involving land titles or personal property. So we serve as the central repository of all these documents. The PPSR, okay, modify that in terms of registering secured transaction on personal property, because the registry will no longer be the repository of these documents, but what the grantor or the parties concerned are to register are mere information as contained in these secured transaction agreements. So we are notice-based and we are not jurisdictional. Unlike in the old I keep saying Jurassic, but you have to forgive me. Okay, archaic. In the old archaic procedure, all right, the registration of any transactions, either land or personal property, lies within the jurisdiction where the collateral is situated. Right? In the advent of this PPSR, insofar as the personal property registration transactions, it is no longer, the jurisdiction is no longer, it's shall we say, not really worldwide, but it knows no border. So it's a centralized. Now, another feature is online 24/7 availability. In other words, since it is a web-based registry, okay, anyone can just log in using the user account and would be able to search notices on a particular collateral and know which collateral has been mortgaged to this grantee, or whether this collateral has already been mortgaged to another junior encumbrancer, so forth and so on. Okay, next slide, please. Now, well, this is a high-level process flow, but for the sake of our bank representatives here present now, I just would like to give you a walkthrough on how the PPSR would operate. First, the grantor or any client for that matter would create an account. Then he will enter the information on the web the moment he is given a user account. Then, of course, there will be payment. Then he will receive a final confirmation, and then payment, and then confirmation or notification of registration. And then, ergo, that information, that notice is already announced to the public. Now, when is the reckoning period by which we can say that the interest has already been or constitute public notice. Okay, as soon as this notice is available to the public. Okay, next slide, please. Now, another, again, this is supposed to be a high level, but this actually refers to the list of services by which the PPSR would provide for the clients or the parties. No, we have the user management, the creation of an account. Okay, remember that in the creation of the account, the LRA registry has no business of creating an account because that power lies only with the grantor, the client. Okay, so the LRA has no power to create an account and come up with a transaction. All right. The other service that the PSR would endeavor to provide is notice management. Okay, so by means of the account earlier created, the user, whether it is a juridical user, our guidelines provide that the juridical user would refer to bulk end user, the banks, the institution, the clients that have juridical personality. Of course, that is in contrast with an individual mortgagor or a individual grantor. Now, insofar as search is concerned, okay, it is open for as long as the client or any party for that matter can secure an account and goes into the system by logging in the website of the PPSR. All right, next slide, please. Okay, now, where are we now? Next slide, please. Insofar as LRA is concerned, we have launched actually, prior to this virtual launching, we have actually launched the PPSR in our website last March 25, 2021. Now, what does that launching, soft launching entail? I would like to discuss that in the next slide. Next slide, please. All right. If you will read the law and the corresponding internal interim rules and regulations, it provides for a transitional period. All right? It provides for a transitional period by which, upon the implementation of the PPSA, upon its effectivity, okay, there will be a transition from the effectivity of the law until the full implementation of the PPSR, of the registry. As I have mentioned earlier, we cannot simply leapfrog from a manual registry into a new technology, which is the PPSR, without first developing our system. All right, now, it gives us the advantage, the LRA gives us the advantage to more or less leapfrog into new technology because as of now, we are now being assisted by our third-party provider, which developed our land titling computerization program. So this PPSR is a mere dovetailing of the existing electronic chattel mortgage registration. All right, now, from an electronic chattel mortgage registration, we have to migrate this data from this electronic chattel mortgage registration registry, which is within the ambit of the old law into the new PPSA. So we have to have that transitional period. So the IRR says the transitional period is from February 2019 as provided for under the IRR, and the full implementation of the PPSR. Now, the question is, are we in that stage already of the full implementation of the PPSR? Well, I have to manage your expectation because we are not yet in that stage. Why? Because we are still in the process of migrating this data from the existing electronic chattel mortgage registry to the new registry. Now, there are instances where, in the meantime, this data in the electronic chattel mortgage registration, okay, the transaction or the perfected, no, the perfected interest pursuant to the old law has already ceased to exist or has already been terminated. And so there is no more need to migrate, okay, to migrate to the new registry. On the other hand, there are data that needs to be migrated and re-registered to the new registry notice, to the new PPSR. That is why this our guideline, which by the way we have come up with an LRA circular number 12, 2020, which was very recently issued on March 22, 2021, which speaks of that transitional period. So for those clients whose chattel mortgage data, which are in the old or the existing electronic chattel mortgage registry, which have not yet expired or terminated, they have the option to have it re-registered in the new PPSR. That's why we have come up with that some sort of guideline first, prior to the full implementation. All right? Now, with this, we realize that there are a lot of clients, especially those juridical users, that have voluminous records or transactions still in the existing electronic chattel mortgage registry. All right? And so we come up with a solution that by way of an LRA assisted migration. Next slide, please. Next slide. Yes, that's it. So for those juridical users that have voluminous transactions that have to be re-registered, right, or migrated to the new registry, we have come up with a solution that LRA, all right, by way of perhaps an agreement with the banks or any other institution, we can assist them in trying to, shall we say, inventory all of these transactions which have to be migrated. Because as I have said, not all those transactions that are under the bin of the electronic chattel mortgage registry will have to be re-registered. So the client shall have the option to have it re-registered. Now, why does it take for the LRA to implement fully the PPSR? Now, there are a lot of challenges. Ang sabi nga ni, as my good professor has pointed out earlier, the delay in the implementation of the full development of the PPSR, we ought not to blame to anyone. First of all, there is pandemic. But one of the challenges actually that poses a challenge to the full implementation is the determination of the corresponding fee. I am glad to inform everybody that the DOF has already come up with the draft AO that would contain the final schedule of fees. And I think after the finalization, this will be subjected to public hearings to the corresponding stakeholders. So that is one of the, shall I say, minor challenges that have posed a hindrance on why the PPSR cannot, as of yet, go into full blast. All right, but in our guideline, the LRA commits to finish this transitional period, the migration, the re-registration, in 18 months, okay, depending on, of course, the cooperation of bulk end users or juridical users. Next slide, please. Now, what are the things, as aptly discussed earlier, the challenge, one of the challenge way ahead is information education to all stakeholders. What is PPSA in general? And in specific, what is this new monster called the PPSR, the new registry? So the LRA, together partnered with our stakeholders, the Bankers Association of the Philippines, the Cooperative Banks Associations, the Rural Bankers, and all the stakeholders have been conducting public hearings. We discussed the need to re-register, to migrate from the system, and we provided a walkthrough. Okay, and selecting some selected end user, we let them on hand conduct end user testing of the system. All right. Another thing, next slide, please. Another thing, in our website, we have created a PPSR Information Center website, okay, where we provide the frequently asked questions, the user guides, and all those details, okay? So it can be accessed through that site as reflected on the screen. Another way by which we inform the public, next slide please, is we also, by way of our website, we created help desk for service requests or system related issues. We also...
Actually, for this one, in the PPSR to, no, for the last question. Oo. Dahil nga po wala na tayo masyado.
Dep Bob, you're on mute. Can you please unmute?
All right, sorry. So the LRA has also come up with a help desk through our website for service requests or system related issues, for queries, requests for trainings, and for general information to the public. Next slide, please. I guess that's all for the LRA in the update of the recent status of the PPSR. I hope, as mentioned, as pointed out earlier by Mr. Wolford, the LRA, by so creating the PPSR as mandated by the law as the establisher and the manager of the notice registry, have managed to comply with the 3 tick boxes: transparency, efficiency, and Well,
Enforceability.
enforceability, we do not actually warrants the enforceability because as mandated by law and as mentioned by our administrator, under Section 35 of the PPSA, the LRA as the manager or the notice registry does not determine the sufficiency, the correctness of the information given in that notice, or even the validity of information of the given to that or lodged into that notice registry. So that would be all. Thank you so much.
Thank you, Dep Bob, for such an exhaustive discussion of the PPSR. And I know that so many people are already excited about the launch of the registry and would want to take advantage of it. Now, for our last speaker today, and he is going to talk about warehouse receipts and why it is critical to the credit infrastructure, especially of the agricultural sector, is SEC Commissioner Javi Paul D. Francisco. Similar to Director Jerry and also to Dep Bob, Commissioner Javi is a career public servant who has been with the Philippine Securities and Exchange Commission for almost 20 years now, starting out as a Securities Counsel 2 in 2001. He is now, prior to his appointment as commissioner to the SEC, he was the SEC's director for its Davao Extension Office. Commissioner Francisco currently supervises the company registration and monitoring department, which is in charge of the registration and monitoring of corporations and partnerships. In such capacity, he is also in the forefront of the ease of doing business efforts of the Commission and the development of automated registration and related systems. Okay, so Commissioner Javi, you have the floor. Thank you very much.
Yes. Hi, good morning, Asectes. Just to clarify, my first name is pronounced JV, but that's okay. I get that all the time.
I'm sorry, it's JV.
That's okay. So let me share my screen. Okay. So yeah. So distinguished guests, headed by Secretary Carlos Dominguez, our partners in the FIDN network, ladies and gentlemen, good morning. My presentation today will be on the salient features of the warehouse receipts bills now pending in the Philippine Senate. This project seeks to modernize the warehouse receipt system in the Philippines, primarily through an accreditation process for warehouses that are already issuing or intend to issue warehouse receipts, and through a transparent and reliable electronic warehouse receipts registry. All told, the goal is to enhance financial inclusion of farmers and MSMEs by providing them better access to credit by using warehouse receipts as collateral for loans. So since the passage of the present warehouse receipts law, Act number 2137 in 1912, the warehouse receipts system in the country has not kept up with the times to fulfill its purpose of mobilizing financing to farmers and MSMEs. Over time, financial institutions lost confidence in the system of lending based on warehouse receipts as collateral. Following the effectivity of the Personal Property Security Act, or Republic Act number 11057, which allowed the creation of security interest over movable properties as security for loans in order to promote economic activity, most farmers, as we all know, commonly available personal property with commercial value are their crops or agricultural products. And through the proposed warehouse receipts bill, a modern framework will be established for the storage of goods in warehouses, for the issuance of warehouse receipts, and for the transacting of interests therein. With this modern framework, confidence over the integrity of warehouse receipts will be enhanced, and further, their use and acceptance as security for loans will be encouraged. The objectives of the Warehouse Receipts Bill include financial inclusion of those in the agricultural sector by providing access to low-cost credit using warehouse receipts as collateral. Through the Warehouse Receipts Bill, holders of warehouse receipts, particularly those in the agricultural sector, will have a convenient access to finance. This in turn will enable farmers and crop growers to increase food production or to improve the quality of their produce, and ultimately reduce poverty incidence for those in the agricultural sector. These objectives are intended to be achieved by the Warehouse Receipts Bill through one, the professionalization of the warehousing activity, and two, by the establishment of an electronic warehouse receipts registry. With regard to professionalization of warehousing activity, under the proposed legislation, warehouse operators who intend to issue warehouse receipts have to be properly accredited. Through accreditation, warehouse operators can be properly identified and can be made accountable for their actions. Accreditation also provides certainty that the activities of every accredited warehouse operator meet certain standards, and these standards are necessary to maximize the shelf life of goods, minimize or avoid damages and wastages, guarantee accurate weighing and quality grading, and assure farmers that their products are accurately valued. With regard to the establishment of an electronic warehouse receipts registry, under the proposed legislation, an online registry containing relevant information on warehouse receipts will be established. Only accredited warehouse operators may create an entry in the registry for which an electronic warehouse receipt will be issued. Through such a registry, the public, especially the banks and other financial institutions, may easily verify the quantity and quality of goods covered by each warehouse receipt. And the SEC is tasked under this bill to create the online warehouse receipts registry. Thus, by professionalizing the warehousing activity and by establishing a warehouse receipts registry, warehouse receipts could be considered as a credible collateral under this proposed bill. As warehouse receipts become credible collateral, the risks of extending loans to farmers will be reduced. Farmers may then use their harvests, evidenced by warehouse receipts as collateral for securing their loans, to increase their production or to improve the quality of their produce. There are two proposals on how the accreditation of warehouses will proceed. One is through the Accreditation Council composed of permanent members, the SEC chairperson, the Department of Agricultural Secretary, the Secretary of Finance, and the Secretary of the Department of Trade and Industry, and three non-permanent members and warehousing experts chosen by the permanent members. This is covered under the Senate Bill number 632 by Senator Pangilinan. The other proposal, on the other hand, is to have the SEC as the primary sole regulatory body in charge of all matters related to warehouse receipts, including accreditation. And this is covered under Senate Bill 2049 of Gatchalian and the House Bill number 8698, which has already been passed by the House on third reading. But at any rate, however it will appear in the final version of the law, the Warehouse Accreditation Council's function will include the institution and operationalization of a system for accreditation of warehouses, the issuance of certificates of accreditation to qualified warehouses, monitoring of the performance of warehouses and the submission of reports, and the licensing of inspectors, graders, weighers, who will assist in ensuring the quality of the warehouses. In addition to heading the Warehouse Accreditation Council, the SEC is also tasked to establish and administer an automated registry for warehouse receipts, as mentioned earlier. These tasks are in response to a trend recognized by the International Organization of Securities Commissions, or IOSCO, wherein financial regulators play an increasing role in regulating the warehouse receipt system, especially when warehouse receipts are issued electronically and subsequently traded in exchanges. So the updating of the current warehouse receipts law aligns with the Duterte administration's 10-point socio-economic agenda, particularly on the promotion of rural and value chain development toward increasing agricultural and rural enterprise productivity. Again, this would be done by enhancing availability of credit to farmers and MSMEs using their products as collateral. We expect that farmers and MSMEs could be able to transparently store their goods and easily obtain loans from banks using their electronic warehouse receipts as collateral. Moreover, the creation of a central repository of information on goods and crops through an electronic registry could provide critical data on food inventory, which can be collected and utilized by the government in making strategic policy decisions concerning food security. In addition, the creation of an electronic warehouse receipt system will enable government to address hoarding concerns by having oversight as to the contents and quantity of goods in accredited warehouses. The warehouse receipts bills are also consistent with the government's Balik Probinsya program in providing financial support to local farmers and in encouraging the development of storage infrastructure nearby the agricultural areas. These current efforts at the modernization of our warehouse receipt system are steps toward the right direction in agriculture and MSME finance. Through the warehouse receipts bill, the perceived risks in granting credit to those in the agricultural sector will be reduced and their access to credit improved. As an end note, we hope that our various partners in the FIDN network and other stakeholders will take a good look at the proposed bills and eventually express favorable endorsement in the Senate for the passage of a new law modernizing the warehouse receipt system in the Philippines. So,
Thank you, Commissioner JV. I hope I pronounce it well now.
Thank you. That's right.
Thank you very much. We have a very full chat box. It's full of questions, but thankfully Director Jerry has already replied to most of them. Here's one for you, however, to Direct Jerry. You mentioned CIBI. Do you know if coordination is being initiated with CIC, the Credit Information Corporation, as well to strengthen government and private sector collaboration? Direct Jerry?
I thank you for the question, ASEC. Unfortunately, we have not been updated yet by the CIC on this matter, but definitely we will keep you informed as to the initiatives now that is being done by the CIC on this matter. But definitely they are on their way to improving this platform in order to be useful to not only to the MSMEs but even to the banks, to the banking sector. So most of the users of their application their apps actually are the banks that are intending to offer their financial facilities to the MSMEs.
Okay, so thank you. Here's one to, Ski Dep Bob. You have also a lot of questions here. But first, let me touch on you being a well-renowned lecturer, your role in the academy. Is the PPSA one independent subject being taught in law school? How do you think we can ensure that it is taught consistent with the original spirit and rationale behind the amendments as worked on by the TWG?
Is that question addressed to me, ma'am?
Yes.
Yes. I understand that the PPSA is now being offered as an elective subject. in some of the law schools. I understand that I think Ateneo has already offered as one of the elective subjects. And the next question is it relevant? Well, of course, as I have pointed out, as pointed out earlier by Attorney Lim, there is now an obligation on the part even to law firms to empower their lawyers to be adept in the law, because as it is now, upon the full implementation of the PPSR, the current system of electronic registration of chattel mortgage will have to end. And so therefore, there is now an urgent, no, shall we say, there is now an urgent requirement for practitioners to to have a more or less grasp on the law. And LRA would always be on hand to assist, well, in the information dissemination and education insofar as the notice registry is concerned. But as to how the law, the basic legal principle, I think, it is up to the academe, to the law professors to explain that, and not really LRA.
Okay.
Thank you.
Thank you. I'll get back to you later with some more questions in the chat box, Bob. May I go to Chris? We know that, and this has been mentioned by I think Anthony Francis in the previous session, that banks are rather slow to face the new landscape. They're very wedded to how they've done things in the past. And I will use Bob's description of they can be Jurassic or archaic in the way they do business. So how can we ensure that the reforms that we're doing for credit infrastructure allow them to see MSMEs, farmers as viable clients? So I'm probably asking how we can remove the blinkers from the eyes of our bankers. So Chris?
Sure, thank you. I think there's a couple of different thoughts on how to move the banking system forward to expand that access to finance. So in one sense, I think a number of SMEs, they already know, MSMEs, they already know through, whether it's through existing products, whether it's through credit cards that they may provide to the personal, the individual who runs the small enterprise, or depositors. And there is obviously in-house knowledge they can build off of that. So that's a good place to start, where they already know the borrower. As they look, although I think as banks look to embrace the opportunities afforded under the PPSA for movable asset lending, the idea is to marry that borrower knowledge that they have with the development of a product group. And there are, just like if you think about movable asset finance as various tools in a toolbox or tools that are available to help entrepreneurs, each tool may be simple or it may be complicated and require different skills and different knowledge to use or operate, right? Just like machinery or construction equipment and the like. And so banks can start can start and expand their scope of products, more simpler products, and as they develop expertise and confidence, and in typically a product group that specializes in whether it's asset-based lending, whether it's factoring or leasing or warehouse finance, they start to develop that expertise. That expertise they then gain confidence to continue to expand and broaden the scope of borrowers. So I think I think the first step is to start small, start at some of the easier products. So you heard a lot of the discussion today was on supply chain finance or factoring and leveraging some of that. That's very common in developing markets where they're starting to build the products and the expertise, and from there you can evolve into warehouse finance or inventory finance, which has elements of valuation attached to it. How do you value? How do you control the collateral? And then into more complicated asset-based lending.
You're muted, Chris. I think you lost audio. Okay.
Did you? Hopefully you heard hopefully you can hear me now.
Yes.
And hopefully,
yes, you're back.
I was just finishing my comments as well.
Okay.
So I was just saying they can evolve up to from the simple structures up to the more complicated ones. Like you see in other markets. But I think the idea is to start with some of the more simpler structures. Perhaps start with borrowers that they already know from other products, and expand from there.
I hope the bankers are listening. Thanks, Chris. Now for ComJV, a couple of questions for you. Many people believe that warehouse receipts will benefit only farmers, but I heard in your discussion earlier that this is also for the benefit of the MSMEs. So how will this benefit MSMEs, and how can the operationalization of warehouse receipts help in the growth of e-commerce? You're on mute, ComJV.
Well, we know, Tess, that especially with the pandemic right now, there has been a lot of transactions trading through e-commerce portals. So this is one avenue where we can sort of leap from the commodity sector, commodities finance, particularly because traders here can accredited warehouses that issue warehouse receipts, and traders may be more confident to enter into arm's length transactions because again, through the electronic registry, everything is transparent. There's integrity in the system, so they'll be able to see the actual amount of commodity, the nature of commodities, the volume, etc., and so many other information. In fact, between the electronic warehouse receipt and the paper receipt, under the law, it's the electronic warehouse receipt that will prevail, because again, sort of it's indubitable, shall we say, as evidence of actual products in storage.
Thanks, JV. Now, Dep Bob, hello, are you still there?
Yes, ma'am.
Sir,
Yes,
one last question for you is just to allay the concerns of some of our guests that there might be fake titles which are in the registry of LRA right now. So how do you allay these fears? How will LRA protect the integrity of the registry?
I hope the discussion would center on personal property security interest. No? But if you're talking of land type,
they've been
registered land
talking.
transaction,
Yes.
of course, I can always discuss that. One of the objective of the so-called LTCP or the LRA's land title computerization program is to have a secured information, secured data. No? One of the initiatory moves that we established is to inventory. Before we uploaded all the active titles, no? Meaning existing titles or extant records in our registry voids. No? We have an inventory. And in that inventory process, there was some kind of a quality assurance,
Okay.
where the respective registry personnel are actually involved. And so they are in the best position to determine the any issue of authenticity or regularity of the records that are extant in their vaults. So, well, uh, the problem actually lies because in our legal framework, there are two sets of title. I mean, the physical title of the owner's duplicate copy, meaning the one that is in possession by the registered owner, we have no control of. Okay, what we have control of are the original copy that are supposed to be in our vault because we are the repository of those. It's good that because of the land title computerization program, we have already digitized this. And so now, our registry vaults would no longer contain a physical copy of these titles once they are already uploaded in the database. But the problem lies, what about the owner's duplicate copy, which are in possession of each and every one of us, title owners? Yun po yung pinipeke. Those are the titles that are fake and somehow would be able to get entry to the system because of a particular transaction. I think that that would allay the fears of our registrants.
Thank you, Dep Bob, for that. Now, I began the Q&A with Director Jerry, and now I think I will end with him. So, Direct Jerry, from your years of experience in MSME financing, can I call you the guru of MSME financing for today? So, what is the one thing, just one thing from your view, that private sector and government can work on or contribute that is most valuable for MSMEs to weather the pandemic?
Well, one thing that we're trying now to capacitate our MSME potential borrowers on are really a valid proposition to the financial institution, because unless you have a valid, viable, and feasible proposition, definitely you will not be able to get financing. So in fact, now most of our capacity building for our MSMEs require them to also do some pitching. So in a way, they are now trained on what are the various areas or dimensions of their businesses that need to be expounded whenever they're applying for loan. So this is one thing now that we're trying to also inform our MSMEs, that definitely any financial institution will not just give anyone the finances if you are not even clear as to what are the usage of your financial availment and what are now what's the opportunities that are in store for you in terms of the uses of that financial facilities from the bank.
Okay, so thank you. So that means first, you know yourself, what is it you're trying to sell, and what advantages, what benefits will you derive from getting the financing. So thank you to my distinguished panel of speakers. This has been a very productive session, very engaging, very informative also. And I think it also points a way forward for us on how to improve credit infrastructure, especially for MSMEs and farmers. And probably I would just leave a question hanging in the air on whether we are actually making a false dichotomy between farmers and MSMEs, because farmers also need to become probably entrepreneurs in the future, add more value adding to their products, and that could be the more viable way by which we can lift them up from the poverty that they have been in for a long time. So thank you to my panel of speakers. Chris, see you again in the next FIDN, hopefully. Director Jerry, ComJV, and Dep Bob. Thank you very much. Now I turn over to our host today, Domeng. Thank you.
Thank you, Assistant Secretary Habitan and panelists, Mr. Chris Wallert, Director Jerry Clavicilias, LRA Deputy Administrator Robert Omar Leretana, and SEC Commissioner J.V. Francisco for that informative session. We have now come to the end of our conference. I take this opportunity to thank our partners in the Department of Finance and our hardworking FINEX Secretariat for enabling us to conduct this conference successfully, despite a short period provided for preparation. Please allow me now to call on Undersecretary of the Department of Finance, Gil S. Beltran, to deliver the closing remarks. Undersecretary Beltran, sir, you now have the floor.
Good afternoon, everyone. Thanks to all of you for participating in this event. I would like to express my gratitude to our speakers, facilitators, and panelists for the valuable contributions. We can confidently say that we have fully achieved our objectives of the conference, even as we missed the opportunity to sit down together in a physical venue because the threat of the virus is still around. We hope that the exchange views and insights from our two-day discussions will serve as important inputs as we move forward with our remaining agenda under the FIDN platform. We need to continue with the reforms in order to realize a long-term impact. There are still many bills being pushed in Congress, like the Warehouse Receipts Bill, which is now in the Senate. This is the main reason why we continue to collaborate with other government agencies and partners in various sectors. We need to upgrade our systems and keep them at par with the increasing sophistication of financial products and services. We need to continue our work on financial literacy, capability building, and skills training for our entrepreneurs. With the passage of RA 11057 or the first PPSA and the issuance of the implementing rules and regulations, we hope that our MSMEs, farmers, fisherfolk will become more enterprising and encouraged to access the financial system with their movable assets as collateral. As we go back to our respective offices or home offices, let us continue to work on our shared vision and be relentless in our efforts to create an enabling environment for our MSMEs, farmers, and fisherfolk to sustain their operations and bounce back from the pandemic as more resilient and more effective partners for development. We hope that everyone will make most use of this conference and continue pushing for reforms to make the region's financial system more integrated and inclusive. Special thanks go to our development partners, particularly FINEX, who helped organize this event. Thank you very much, Attorney Lim and Ms. Kay Santos for spearheading this event.
Yusek, you're on mute.
Wait, I was on mute. Did you hear that I thanked FINEX a while ago?
Yes, yes.
Okay, that was the last sentence. Now I'm turning over the microphone to our MC. Thank you, FINEX.
Thank you, Undersecretary Beltran. And that marks the end of our two-day conference, ladies and gentlemen. Thank you for taking time out to join us. I trust this has been an informative conference for all of you. Goodbye now and take care. Stay safe. Bye-bye.